Hey guys, Akil Stokes here, and welcome back to another episode of the Trading Coach Podcast, a video episode, so welcome YouTube viewers. Earlier this week, I recorded a special bonus episode where we broke down some of the major news events that were sitting on my radar, or I guess the market's radar, for the week to come. And if you remember, I mentioned that two of the big ones, the main event, were going to be Tuesday's CPI report and Wednesday's PPI report, which were both inflation-based reports. Well, both of those reports definitely left a footprint on the financial markets, and that's what I want to come in and discuss with you today. Now, if you're new to trading or to economics in general, don't worry. This episode is going to break things down in a very simple, beginner-friendly way that hopefully everyone could understood. My background is not in fundamental analysis. I'm a purely technical trader, but something I've done over the years just to get a better read of the market and to have better conversations with fellow traders in the industry is learn about the fundamental side of things. And the best advice that I give to the traders that I work with is this: you don't need to go to school or take a course to become an expert. You just simply need to pay attention. You need to track what is coming out. You need to read an article or two just describing what it is. And most importantly, you need to see how the market reacts to it. That way you can gauge its importance. And if you make a habit of doing this on a regular basis, before you know it, you're going to know enough to increase your edge in the market. Or again, at least be able to have quality conversations when this type of weird mumble jumble is brought up. So hopefully this video, and if I keep doing this series, which you guys have seemed to like so far, hopefully this is the dumbed down version that allows you to learn a little bit. And who knows, maybe a year from now, you can be an expert as well. Or again, just good enough. Anyway, let's talk about what happened, why the markets reacted the way they did, and of course, what traders should be paying attention to moving forward based on this new information. And we'll start with Tuesday's CPI report. Now, the CPI stands for the Consumer Price Index, and this is basically one of the main ways that economists measure inflation in the market from the consumer side. So in simple terms, what it does is it tracks what prices we pay for everyday things like food, gas, housing, rent, travel, clothes, healthcare, all of that fun stuff. And in April, because we always get the numbers from the previous month, this CPI came in hotter than expected, right? Prices rose 0.6% for the month, while yearly inflation is now running at 3.8. Now, to put that in perspective, because I know it's a lot of numbers, they don't really make any sense. The Fed ideally wants their inflation to be closer to 2, right? 2% on annual. So yeah, inflation has cooled from like the insane levels that we saw a few years ago, but we are still well above the Fed's comfort zone or ideal zone. But honestly, what made this report more concerning, because I think the market kind of expected that, was where the inflation was coming from. Energy prices jumped 3.8% during the month, with gasoline prices now up more than 28% compared to a year ago because of those geopolitical activities that are happening in the Middle East. And this is why inflation feels so close and personal to people. Because when things like gas prices rise, which we use on a regular basis, and things like groceries become more expensive, which we use on a regular basis, and when rent keeps climbing, which many of us pay on a regular basis, we start to feel it right away. Now, there are different types of CPI, and they're kind of divided into different numbers that come up. And another type that economists pay very close attention to is what's called the core CPI. And what the core CPI does is it takes away things like food and energy, because those are the categories that tend to have like these wild swings, and sometimes they can corrupt the data. But even with those wild swingers, ooh, that was weird, taken out of the equation, inflation still stayed elevated, right? The core CPI rose 0.4 for the month, and that put it at, I think, 2.8% annually. And what this does is it tells us that this inflation isn't just about oil prices, and it's not just kind of like a one-off temporary issue. It is spreading into many areas of the economy as well. For example, I think we mentioned rent earlier, but things like airplane tickets, things like clothing prices, and again, normal household goods, all of those things became more expensive. So not just the gas and groceries. And when that happens, it is pretty much the exact opposite of what the central banks want to see. Now, one more other important piece of data that kind of got overlooked in the bigger schemes is that workers are actually losing ground as well, as far as like earnings and whatnot. So real average hourly earnings, which basically means like your wages adjusted per inflation, they fell by 0.5 during the month as well. So although people may be technically earning more, those dollars just aren't stretching the way they used to because prices are rising faster than those wages are rising. And something I just learned, right? There's a term for this. This is called a financial squeeze. That kind of felt good. So to sum it up, people are working, people are making money, but life still feels more expensive. Can you relate? Now, shifting over to Wednesday's report, so going from the consumer side to the producer side, we had the PPI, right? And again, PPI, Producer Price Index. And what this is tracking what prices companies are paying before the costs eventually get passed down to us, the customers. Now, heading into the report, markets were holding on to a small hope that the inflation pressures were finally starting to cool off. But what they got, once again, was the exact opposite, right? PPI in April rose over 1.4% month over month, when economists were expecting about 0.5%. So a big miss on that, as the report came in significantly hotter than what was anticipated. And again, this is that deviation from the expectation that we always talk about moves the market. On a yearly basis, producer inflation jumped to 6%, up from 4.3% previously. And the core PPI, again, taking out the food and the energy, also came in hot, rising 1% for the month, which was actually the strongest monthly increase since March of 2022. So overall, this report basically told the markets that inflation pressures are still hanging around and maybe even picking back up again. Speaking of again, just like the core CPI, the numbers showed that this wasn't just kind of a one-off or one category type of issue. It was more broad spread around the economy. Service inflation, for example, jumped by 2.5%. And this is something that is looked at as being very sticky. And what I mean by that is this. Goods inflation tends to kind of heat up and cool down pretty quickly. Sticky inflation does not. It kind of hangs around. So when the Fed sees kind of the sticky, right? Service, it's getting sticky, right? The sticky service inflation, the higher energy prices and rising inflation expectations, again, it puts it in a very difficult situation. So let's talk a little bit about the changes in inflation expectations, right? Because those are obviously creeping higher than what they were heading into these reports. 5-year inflation expectation rose roughly from 2.2% to 2.7%. Now, I know that doesn't seem like much of a jump, but psychologically that matters a lot, because once consumers and once businesses start expecting inflation to stay high and not cool off, that mindset can actually keep inflation high and stop it from cooling off. It's one of those self-fulfilling cycles where like the opposite of belief action results, where everything gets stronger and good. This is the opposite counterclockwise version of it, where everything gets bad because we expect it to get bad and worse. And because we expect it to get bad and worse, it does get bad and worse. Yeah, that. Anyway, naturally, when this came out, markets started adjusting what they think the Federal Reserve may do next, right? A few weeks ago, right? Not too long ago, a few weeks ago, investors were still holding out hopes for an interest rate cut this year. Now, I got to give a shout out to Devin. I know you're watching this, Devin. A few weeks ago, we had this conversation in the live room, and I said, hey, the market's still expecting maybe a cut or two. And he's like, no way in hell, man. It's not happened. Looking at the yields. And I'm like, well, hey, I'm just here to tell you what the market said. And well, a couple weeks later, after news, the market has changed its mind. And Devin, you were right. So hats off to you, my friend. And just to recap that, because I went through it rather fast, the markets had been expecting us to go into a rate cutting cycle. That rate cutting cycle expectation has gotten less and less, to the point where it's at, hey, maybe one by the end of the year, definitely not here in the summer. And now I think that rate cutting expectation is pretty much off the table. And if anything, I think the market is now considering the possibility of a rate hike down the road if this inflation continues to heat up. And what fun this must be to our brand new Fed Chair, Kevin Warsh, who will be taking over for Jerome Powell when he steps down, right? And yes, if you guys remember the podcast we did on this, Warsh is seen as a presidential puppet, right? Donald Trump is in the Fed meeting pulling the strings, and Warsh is doing everything that he wants to do, and Trump still wants lower interest rates. But despite political pressure, the Fed's primary responsibility is inflation control, and yeah, inflation is simply not cooperating with Trump's wishes of lower interest rates. So he's in a fun position. Now, just to get on to some other stuff, because I found this interesting, and this did affect how the markets moved. After the inflation report came in, Treasury yields moved higher immediately. The 2-year yield pushed back up above 4% at the time, and then the 10-year yield moved to 4.5, something like that. And again, this is important because this has to do with borrowing costs throughout the economy. So things like mortgages, things like business loans, things like your credit card, for example. These things all tend to move with Treasury yields. That's why they do have importance to us. Now, with that being said, after that initial spike, yields did kind of calm down later in the session. And that's one of the main reasons we saw the market react in a way that was a little interesting, I guess you can say. Now, before we get into the forex market, which is my specialty, we'll talk a little bit about the stock market because they had an interesting ride as well. Initially, stock market futures sold off after all the inflation data came out because higher inflation, higher interest rates, not exactly what they want to hear. But then something interesting happened and the markets reversed. In fact, I should say this. Not only did they reverse, but both the S&P and the NASDAQ pushed to record closes by the end of the day. However, the Dow didn't, if I remember correctly. That was either break even or slightly negative, if my memory suits me. Now, as far as currencies go, the dollar finished mostly stronger overall. Again, you would expect that. Inflation, interest rate hikes, strong for dollar. But it did end up pushing back a little bit after the yields kind of settled down by the end of the session. And that personally made me happy at the time. I'm not very happy right now, but I am in a euro dollar long position right below the 117 handle. And that little bit of easing, right, because I'm going short the dollar technically, right? That little bit of easing did cause the market to start moving in my direction. And then news came out today. What is this? Thursday I'm recording this. And we're plunging back down. So not stopped out yet, still fighting the good fight, but definitely not having a positive outlook about this trade. Now, I know what you're thinking. Akil, all this news came out. Why the hell would you be short the dollar? You just told us inflation up, interest rate hikes up, dollar strength. Well, you got to keep in mind, I am a purely technical trader. Therefore, all of my decisions in the markets are made off of technical decisions, and this was a purely technical decision. I'm not in the business of trading off of thoughts and feelings. I know some of you guys may feel a certain way about that. I'm in the business of trading off of data and consistently following data and exploiting my edge. That has worked for me for a very long time, and there's no need to deviate from that and do something different now. Anyway, back to the fundamental stuff because I don't want to look at this thing. It's being very, very naughty to me. But later in the day, we also heard from a few Federal Reserve officials as well. Fed member Susan Collins emphasized that inflation risks remain elevated and warned that rates may need to stay restrictive for longer than markets would like. She also suggested that inflation may not cool off in a meaningful way until 2027, which again is not something that investors really want to hear. She also mentioned that geopolitical tensions, or especially the ones tied to the Middle East, could create additional inflationary pressures while simultaneously slowing economic growth, which is a combination that simply screams nightmares for central banks. Sorry. There was also another member that spoke out later, I forgot who it was, I apologize, that echoed the same concerns. So you got two Fed officials saying the same thing. So where does that leave us as traders? Well, right now the markets are dealing with a pretty tricky environment, I guess you can say. Inflation remains sticky. Treasury yields are elevated. The Fed is being cautious. The war geopolitical risks are rising, and rate cuts are no longer part of the conversation. Instead, the market is slowly shifting back towards the idea of that, hey, interest rates may need to stay higher and may need to stay higher for a longer period of time. And they can even go even higher if this inflation thing keeps accelerating. So moving forward, we need to continue to pay attention to the inflation data. We need to continue to pay attention to these yields, the Treasury yields. We need to continue to pay attention to energy prices. And probably most importantly, we need to pay attention to future FOMC member commentary in order to get those clues. Because all of those things combined, right, and this is why it's fun to be a fundamental trader, all of these things combined are going to shape expectations for monetary policy over the next few months. And once again, that is the main driver in the markets. Anyway, that's it. Another update for you guys. You mentioned after the last video that you liked the fundamental talk, so I am back with more fundamental talk. I hope you enjoyed it. I hope it simplified things. It made sense. If it did or if it didn't, leave me a comment below so I can learn to get better with these videos. And I look forward to seeing you guys in the next video. Again, it's the summertime, so I'm doing a lot more content for the channel on a daily basis pretty much. So make sure you're subscribed and hit that like button. That way it is in your algorithm and you don't miss the next video. Until then, plan your trade, trade your plan. Take care.